As per latest data from AMFI, all Indian mutual funds put together have 12 to 15% of their equity exposure towards just two entities. They are HDFC Bank and ICICI Bank. The landscape of Indian finance is entering a compelling new chapter where the dominance of established giants like HDFC Bank and ICICI Bank is starting to face a credible challenge. As global stock markets wake up to the AI led risk in Nvidia like stocks, it is important to understand why the concentrated exposure matters. Index funds and ETFs in the US had approximately 10% of their assets under management in the stock of Nvidia at the end of 2025. The enormous concentration of capital in Nvidia makes the broader US market highly susceptible to volatility from its earnings or technology cycle swings. Nvidia's current valuation reflects near perfect execution and continued exponential growth in AI. This leaves little margin for error or competitive challenges, which poses a systemic risk. A sudden technological shift or competitive breakthrough could trigger a sharp sell-off, impacting the numerous ETFs and index funds where Nvidia holds significant weight. The massive interconnected trading flows between the stock and related derivatives could amplify any market correction in the US and global markets. In fact, Nvidia's status as a single stock bellwether for the entire AI revolution means any disappointment could lead to widespread sector derating and panic selling. So, the anti-AI fear in global stock markets is not unfounded. Similarly, it is not entirely unfathomable that the giants of Indian banking sector, which enjoy huge allocation in Indian funds, could be dethroned soon. This shift isn't being led by another behemoth, but by the smaller private sector banks who are finding ample room for accelerated growth, supported by a favorable macroeconomic environment and significant global capital inflows. Smaller private banks in India, such as Federal Bank, Karur Vyasa Bank, and regional players, possess a unique inherent advantage: a relatively low base and deep focus on regional and niche markets. The Indian economy remains underbanked, especially in semi-urban and rural areas. While the large banks have concentrated on securing the high-value corporate and HNI clients, the smaller banks have meticulously built trust with local businesses. Micro, small and medium enterprises and the emerging affluent in tier 2 and tier 3 cities are the real customers. These banks leverage their long-standing local presence to attract stable, low-cost current accounts and saving account deposits. This allows them to manage their cost of funds more efficiently. Unencumbered by the massive legacy systems of their larger counterparts, many smaller banks in India are adopting modern digital platforms with greater speed and agility. This allows them to offer competitive services with a lean cost to income ratio. Moreover, they are rapidly expanding their reach without the need for an expensive physical branch network. Given their small scale, even a modest increase in market share translates into very high percentage growth in their loan book, often outpacing the growth of larger and more mature banks. With strong credit retail demand and improving asset quality, which means lower gross NPAs, the smaller banks are perfectly positioned for a multi-year growth run. The recent history of the Indian banking sector, marked by cleanup of non-performing loans, has profoundly influenced investor sentiment. A significant factor here is the improved financial health of India's corporate sector. The resolution of major insolvency cases under the Insolvency and Bankruptcy Code and a general decline in corporate leverage has drastically cleaned up the balance sheets of Indian lenders. The newfound corporate financial stability has brought the spotlight firmly onto the resilience and profitability of Indian banks. Global investors now view the Indian banking ecosystem as one of the most stable and promising in the world. The shift from a decade ago, where global capital was wary of the twin balance sheet problem, stressed corporates and stressed banks, is complete. Today, the foreign institutions see Indian lenders as a structural bet on the country's consumption-driven growth story, making them premium destination for capital. The new stability has created the perfect environment for a massive injection of foreign capital, which is the key ingredient that could help smaller banks challenge the dominance of HDFC and ICICI. Recent deals such as Blackstone's strategic investment in Federal Bank and Emirates NBD's acquisition in RBL Bank signal a deliberate pivot by global financial powerhouses. This capital infusion could be the transformative stage for banks. The money running into billions of rupees instantly shows up the small bank's capital adequacy ratio. This increased capital is the fuel for aggressive expansion, enabling them to underwrite much larger loans and scale their operations to a different level. Strategic investors like Blackstone don't just bring money, they bring global best practices in risk management, digital strategy, and corporate governance. This expertise can help smaller banks rapidly leapfrog their older, more bureaucratic rivals in efficiency and service quality. For a mid-sized bank, even $1 billion in capital represents a far greater proportional boost than it would be for a giant like HDFC Bank. It acts as a supercharger, allowing the smaller entity to fund an aggressive branch expansion and invest heavily in cutting-edge technology like AI and ML for credit scoring and digital lending, or undertake significant digitization of operations. In this scenario, a combination of local knowledge, digital agility, and massive foreign capital gives these smaller players the perfect recipe for a disruptive push. They can target the specific underserved segments that the larger banks have ignored, while simultaneously upgrading their systems to compete on par for high-value customers. While dethroning the market leaders overnight is improbable, the capital from Blackstone and Emirates NBD will enable few well-managed smaller banks to dramatically close the gap with the larger peers. As other smaller private sector banks in India attract such foreign capital, there could be a substantial realignment in the sector in terms of assets, customer base, and stock market valuation. So it is time to keep a close watch on the Nvidias of the Indian stock market. Hope you like this video. Thanks for watching.